Imagine you are standing at the checkout of a grocery store on an ordinary Tuesday evening, the kind of evening where nothing feels unusual. The shelves are stocked, the lights are on, the queue is moving, and the woman ahead of you taps her card on the reader, waits the usual half second, and gets nothing back. She taps again, a little harder this time, the way people do when they suspect the machine rather than themselves, and again the screen blinks and resets without processing. She switches to a different card, a backup she keeps precisely for moments like this, and the result is the same. The cashier looks at the terminal, then at her, with the expression of someone who has already seen this happen 3 times in the last 10 minutes. Behind you, a man in a jacket is on his phone, talking in a low voice that is trying very hard to sound calm. The woman beside him has opened her banking app and is staring at it with a stillness that has nothing to do with reading. You step forward, tap your own card, and wait. The reader blinks. Declined. You try contactless, then insert the chip, then try a different account, and the machine returns the same answer every time. The way a locked door returns the same answer, no matter how many times you turn the handle. You open your app. The balance is there, the number you checked this morning, the number that represents months of work and careful management, and it is exactly what it was, sitting on the screen as if nothing is wrong, as if the terminal in front of you is simply confused about a reality that the app can clearly see. But the terminal is not confused, and you are beginning to understand that the app is showing you a number that no longer connects to anything you can actually spend. Outside, you notice the ATM has a handwritten sign taped over the screen. Down the block, a small crowd has gathered in front of a bank branch, whose doors are locked in the middle of the afternoon, and the people standing there are not the kind of people you associate with financial distress. They are dressed for offices and school runs and evening plans. They look exactly like you, and they are looking at those locked doors with the particular expression of people who came to retrieve something that belongs to them, and are only now being told that the concept of belonging has been temporarily suspended. The radio in a passing car is carrying a news broadcast that uses the phrase emergency measures and orderly resolution in the same sentence, in the tone that official voices use when the situation is neither orderly nor resolved. And somewhere between the locked ATM and the locked branch, and the number on your phone that looks correct but spends as nothing, the thought arrives. Not dramatically, not with a sudden flash you might expect, but slowly, like cold water rising, that your money was never quite where you thought it was, that the account balance was always a claim, not a possession, that the system you trusted to hold what you earned was holding something more fragile than it ever told you, and that the gap between what it promised and what it can deliver has just become, for the first time, impossible to ignore. It sounds like the opening of a nightmare you will wake from. It is not. It is a scene that is played out with different faces and different currencies and different official explanations in countries that were modern and stable and prosperous right up until the morning they weren't. And the history of how it happens, the mechanics of why the system that holds your money is built to protect itself before it protects you, is the most important story about money that almost nobody tells you while things are still working. By any surface measure, Argentina was not a failing state. It had a middle class. It had professionals, business owners, families who had spent decades doing everything the financial system asked of them. Earning, saving, depositing, trusting. The peso had been pegged to the US dollar for 10 years. Stability felt structural, permanent. Then the government ran out of options. Years of debt, economic mismanagement, and IMF conditions had hollowed out the country's reserves. As the crisis deepened, Argentinians who understood what was coming began moving their money, converting pesos to dollars, transferring funds abroad. The banks, watching their deposits drain, sounded the alarm. And the government responded the only way governments respond when the alternative is total collapse. They called it the corralito, the little corral. Cash withdrawals were capped at 250 pesos a week. Dollar accounts, savings that people had specifically opened in dollars to protect themselves from exactly this kind of devaluation, were forcibly converted into pesos at a rate that instantly destroyed a third of their value. Overnight. People who had planned retirements, down payments, their children's education, all of it recalculated at a new number they never agreed to. The streets filled not with criminals or extremists, but with the middle class, banging pots and pans in front of bank branches that had their shutters down. 5 presidents in 2 weeks. 11 people dead in protests. An economy in freefall. That is what a bank shutdown feels like from the inside. Not abstract, not theoretical. Bread and rent and school fees, suddenly unreachable behind a counter that used to be yours to access. Argentina is not alone. Cyprus, 2013. The European Union, managing the fallout from the global financial crisis, determined that the Cypriot banking sector, swollen with deposits from Russian oligarchs and ordinary Europeans alike, needed restructuring. The mechanism they chose was called a bail-in. Accounts holding more than 100,000 euros would be seized. Not frozen temporarily, seized, taken. Used to recapitalize the very banks that had mismanaged the money in the first place. The businesses that kept operating funds in those accounts, businesses that needed that money to make payroll, to pay suppliers, to keep the lights on, had no warning and no recourse. The retiree who had spent 40 years accumulating that balance did not get a phone call. The deposit insurance they had been assured would protect them had a ceiling, and above that ceiling, the rules had simply changed. Overnight, by decree. Greece, 2015. A debt crisis that had been building for years finally forced the government to declare capital controls. ATM withdrawals were capped at 60 euros a day. Not 60 euros more than usual, 60 euros total per person. Per day, people stood in lines in July heat for hours to collect money that wouldn't cover a week of groceries. Weddings were postponed, medical procedures delayed. Students abroad couldn't receive funds from their families. The country's financial system had not collapsed. It was still technically open, but access had been rationed into something that felt indistinguishable from collapse. Lebanon, 2019. The Lebanese pound, pegged to the dollar for 25 years, began its unraveling. Banks imposed informal capital controls, withdrawal limits that had no legal basis but were enforced anyway, because the banks were insolvent and any other approach would have exposed that insolvency immediately. People who tried to withdraw their own savings were told the money was available but not accessible. The distinction between those two things is a sentence that should haunt anyone who keeps their entire net worth in a single institution. When the limits tightened further, when the pound lost 90% of its value on the black market while the official rate pretended otherwise, people stopped asking politely. There are videos, widely shared, deeply unsettling, of Lebanese citizens walking into banks with weapons and demanding their own money back. Not robbing the bank, demanding the return of what was already theirs. The system had made criminals out of depositors. And then there is the United States. 1933, the country that built modern banking. The country that everyone who has never lived through a financial collapse points to as proof that it cannot happen here. Franklin Roosevelt declared a national bank holiday. Every bank in the country closed. For 4 days, no withdrawals, no transactions, no payroll, no commerce. The government inspected the banks, selectively reopening the ones deemed solvent, permanently closing the ones that weren't. It worked, ultimately, as an emergency intervention, but the fact of it deserves to sit with you for a moment. The most powerful economy in the world froze its entire banking system for 4 days to prevent a cascade of failures. One presidential order, and every bank account in America was inaccessible. It happened to them. And the words spoken in Argentina in 2000, in Greece in 2010, in Lebanon in 2018, those same words had been spoken in America in 1932. Now, this country is different. Our system is stable. That kind of thing doesn't happen here. History does not respect those words. It never has. Now let's talk about why. Because the events in Argentina and Cyprus and Lebanon and Greece are not flukes. They are not the result of uniquely corrupt governments or uniquely reckless banks. They are the predictable outcomes of how every bank in every country in the world actually operates, including yours. When you deposit money in a bank, you are not renting a safe deposit box. You are making a loan. You are lending your money to the bank, and the bank is recording your claim on its books. What it does with the actual money, the purchasing power you just handed over, is something entirely different. It lends it out, most of it. The fraction it keeps in reserve, historically somewhere between 3 and 10% of total deposits, is enough to handle normal daily withdrawal requests. The rest becomes mortgages, business loans, car payments, government bonds. Your $1,000 becomes $5,000 of circulating credit inside the same system. This is fractional reserve banking. It is the engine of modern economic growth. It is also, structurally, a house of cards. The house stands as long as everyone believes it will stand, not because the money is there, because enough people don't ask for it at the same time. The moment that changes, the moment enough depositors decide they want their money back simultaneously, the bank cannot comply. Not because something went wrong, because the system was never designed to comply. It was designed around the statistical probability that most people would never ask. When that probability breaks down, the technical term is a bank run. The more accurate term is a revelation. The curtain is pulled back. The vault that everyone assumed was full turns out to hold a fraction of what the ledgers say. And confidence, the only thing that was ever actually keeping the system together, evaporates. It is like fire in a crowded theater. One person moves toward the exit, then 3, then 20. By the time most people are running, the stampede is no longer a response to the danger. It is the danger. Governments know this. They have always known it, And when the crisis arrives, their response is almost always the same, and almost never what you were told it would be. The relationship between banks and governments is not the relationship between a regulator and the regulated, it is a symbiosis. Banks need governments to enforce the legal framework that makes deposits enforceable claims, to backstop them in crises, and to maintain the public confidence that keeps the system running. Governments need banks to buy their bonds, to finance their deficits, to channel money into the economy without the government having to be directly responsible for it. When stress hits, they protect each other. And the depositor, the person the entire system was supposedly designed to serve, is the variable that gets adjusted. Argentina capped withdrawals not out of malice, but out of arithmetic. If they had allowed unrestricted withdrawal, the banks would have collapsed within days, and a collapse worse than the corralito would have followed. Cyprus imposed bail-ins because the alternative, a sovereign bailout, was politically unacceptable to the creditors with actual leverage. In each case, the individual saver absorbed the loss that the system could not. The 2008 financial crisis made this logic explicit in a way that had never been so publicly visible. Banks that had made catastrophically bad bets, packaging worthless mortgages into securities, building leverage ratios that would have been illegal a decade earlier, were deemed too big to fail. The losses they had generated through their own decisions were socialized, paid for by taxpayers who had never held a mortgage-backed security, never worked at a trading desk, never received a seven-figure bonus in a year. The firm lost money. The institutions that caused the crisis were rescued. The homeowners who had been sold mortgages they couldn't afford were foreclosed on. The workers whose pension funds had been invested in the securities that collapsed lost retirement savings they could not recover. The message embedded in that outcome, stated clearly enough if you were paying attention, was this: the system will sacrifice you to save itself. Not as an accident, as policy. Too big to fail is not a description of a bank's size. It is a description of who the system is actually designed to protect. Now, you might be thinking about deposit insurance. In the United States, the FDIC insures accounts up to $250,000. In the UK, the FSCS covers up to £85,000. Similar schemes exist across most developed economies, and they do provide real protection. In normal isolated bank failures, they function as intended. The FDIC has resolved hundreds of individual bank failures since its creation in 1933, without depositors losing a dollar. But here's the question nobody asks in the promotional material. What happens if the failure is not isolated? The FDIC insurance fund holds enough money to cover a fraction of total insured deposits at any given time. Its real power is not its balance sheet. Its real power is the implicit backing of the U.S. government. The understanding that, if the fund itself were exhausted, Congress would authorize whatever was necessary to honor the guarantee. That is not nothing. The full faith and credit of the United States government is a meaningful backstop. But it is a political commitment, not a mathematical certainty. It requires a functional government, a willing Congress, and a crisis contained enough that the backstop remains credible. In a systemic crisis, the kind where multiple large institutions are failing simultaneously, where confidence in the system itself rather than any single bank is what's collapsing, the guarantee is stress-tested in ways its designers never fully anticipated. Deposit insurance is not a lie, but it is not what most people think it is. It is a confidence mechanism, a psychological anchor designed to prevent the kind of panic that makes the crisis worse. Understanding that distinction matters, because it tells you exactly what the system is managing and who it is managing it for. There's one more layer to this that the history books cannot fully capture. Because the world has changed in a way that makes everything we have discussed more dangerous, not less. In 1933, when Roosevelt declared the bank holiday, people still had cash. Physical bills stuck coins in jars. The shutdown was severe. 4 days with no banking was genuinely destabilizing, but there was an analog layer beneath the digital one. You could still buy bread with the paper in your pocket. Transactions that didn't touch the banking system could still happen. That layer no longer exists for most people, in most developed economies. Today, the average person in the United Kingdom carries less than 10 pounds in physical cash. In Sweden, cash is accepted in fewer than half of all retail transactions. In Singapore, in South Korea, in Australia, the infrastructure of physical money has been systematically replaced by digital payment systems. Cards, apps, contactless readers, mobile transfers. The convenience is real, and the efficiency gains are genuine. The vulnerability is also real. In a fully cashless society, a banking shutdown is not an inconvenience with workarounds. It is total. There is no analog layer. There is no cash in the jar. There is no transaction that can happen outside the system. If the digital infrastructure freezes, commerce does not slow, it stops. And here's the other dimension of digital that no one in 1933 had to think about: speed. In March 2023, Silicon Valley Bank, the 16th largest bank in the United States with $209 billion in assets, failed in approximately 48 hours. Not 48 days, 48 hours. A Thursday evening announcement that the bank needed to raise capital triggered a Friday in which customers attempted to withdraw $42 billion in a single day. Not through lines at a branch, through apps, through wire transfers executed in seconds. By the time regulators stepped in on Friday evening, the bank was gone. What would have taken days or weeks in 1929, the gradual erosion of confidence, the building lines outside branches, the slow accumulation of withdrawal requests, happened in the time it takes to scroll through a social media feed. Because that is exactly how it spread. A post, a thread, a group chat. Thousands of people making the rational individual decision to withdraw simultaneously, each one accelerating the collapse for everyone else. The bank run of the 21st century does not look like photographs from the Great Depression. It looks like a notification on your phone. And by the time you see it, the window to act may already be closed. Imagine the grocery store from the beginning of this video. Now stretch it, not for an afternoon, for a week. By day 2, businesses that run on thin margins, restaurants, small retailers, contractors, cannot make payroll. Not because they are insolvent, because the payroll system is frozen. Workers who depend on direct deposit have nothing to spend. The supermarket cannot pay its supplier. The supplier cannot pay its distributor. The distributor cannot pay its drivers. By day 4, the shelves start showing gaps. Not because there is no food, because the chain of transactions that moves food from farm to shelf has seized. Every node in that chain runs on credit, on digital payment, on the unbroken assumption that the numbers will clear. By day 7, the people who had cash, who had diversified, who had physical stores of value, who were not entirely dependent on a single system, have options. They can buy what's available, they can transact, they can help their neighbors in ways that generate goodwill and reciprocity that will outlast the crisis. The people who had nothing outside the frozen system have nothing. This is not a scene from a dystopian novel. Every element of it has happened in some combination in Argentina, in Greece, in Lebanon, in Cyprus. The names change. The mechanism is always the same. So what do you actually do with this? Not panic. The lesson of every financial crisis in history is that reactive fear, the last-minute rush to withdraw, the desperate scramble to convert at the worst possible moment, makes outcomes worse, not better. The people who were wiped out in Argentina were not just the ones who trusted too much. Some of them were the ones who panicked at exactly the wrong time, converting at the bottom, selling at the floor. The answer is positioning. Quiet, deliberate, ahead-of-time positioning. It starts with diversification, and not the watered-down version of that word that means owning a mix of stocks and bonds. Real diversification means holding value in forms that do not all fail simultaneously. Physical cash, enough to cover several weeks of essential expenses, that exists entirely outside the digital system. Precious metals, which have served as monetary anchors across every civilization that has ever collapsed to paper currency. Real property, which cannot be frozen or bail-ined by a distant regulator. These are not radical ideas. They are the financial habits of every generation before the one that decided a number on a screen was the same as actual security. But there is a dimension of resilience that goes further than most people consider. Jurisdictional diversification. If your income, your bank account, your property, and your government are all in the same country, you are entirely exposed to that country's financial decisions. The Lebanese professional who kept dollars in a foreign account before the capital controls were imposed was not a criminal. They were a person who understood that concentration is risk, regardless of what the system currently calls it. Maintaining accounts across different institutions, ideally across different regulatory jurisdictions, means that a failure contained within one country's banking system does not reach everything you have. It is the financial equivalent of not keeping all your eggs in one basket. The fact that it sounds obvious does not make it common. And beyond the tangible, beyond cash and gold and foreign accounts, there's the resilience of productive capacity, the skill that generates income regardless of what the financial system is doing, the community relationships that allow exchange when formal commerce is frozen, the knowledge of how things actually work that cannot be taken from you by a bank closure or currency devaluation. These are not investments, they are infrastructure. And building them before you need them is the only time building them actually works. Here's what ties every story in this video together. Argentina, Cyprus, Lebanon, Greece, the United States in 1933. Different countries, different decades, different triggers, the same ending. Ordinary people who had done nothing wrong, who had followed the rules, who had trusted the institutions they were told to trust, discovering that what they thought was ownership was actually just access. And that access, it turned out, was conditional. The bank does not hold your money for you. It uses your money and records a claim on its books. That claim is only as good as the bank's solvency, the government's willingness to honor its guarantees, and the continued confidence of everyone else in the system. All three of those things can fail. All three of those things have failed. Not in ancient history, in living memory. In countries that looked, from the inside, exactly like yours does right now. The system is not designed to protect you. It is designed to maintain itself. When those two objectives align, you benefit. When they conflict, when the cost of protecting you becomes too high, when the bail-in or the capital control or the bank holiday is the only tool left, you will discover, with cold specificity, exactly where you sit in the hierarchy of priorities. This is not a reason for despair. It is a reason for clarity. The people who understood this, who held value in multiple forms, who maintained options outside the system, who were not entirely dependent on any single institution or any single country, came through every crisis in this video with something intact. Not untouched, not unharmed, but with options, with the ability to act when others could only wait. That is the only kind of financial security that history has ever validated. Not the number on the screen, not the branch on the corner, not the insurance scheme with the reassuring pamphlet. The real thing, the diversified, tangible, skill-backed, multi-jurisdictional, physically accessible kind that survives. Everything else is access, and access can be revoked. Do not confuse access with ownership. If the value you have built only exists at the permission of an institution, it is not yours. Not fully. Not in the ways that matter when the ways that matter are tested. The question is not whether this will happen somewhere in the world again. It will. It always has. The question is whether you will be positioned to watch it from the outside or experience it from the inside. If this changed the way you see the money in your account, if you want to understand the hidden mechanics of your financial system before the next crisis makes them impossible to ignore, subscribe. Every video on this channel is another piece of the map. History is the only map we have. The question is whether you read it before you need it or after.